Hi, everybody, and welcome to the SGK Wealth Compass, where financial insights are clearly explained. Today is Friday, July 24th, and as always, we'll have John Steigerwald and Eric Randolph tell you a little bit about what happened in the financial markets this week. Thank you so much, and I hope you enjoy.
Good morning, everyone. My name is John Steigerwald. I'm CEO of SGK Wealth Advisors.
And I'm Eric Randolph, CFP and Portfolio Manager.
So, Eric, each week we write to our clients topical market events, topical economic news on companies in their portfolio. It's a great information piece for our clients. This week, the headline was kind of negative. The U.S. 10-year Treasury pierced 4.7%, definitely on the rise due to the conflict in the Mideast. Let's talk about the impact on the economy, but how it creates an opportunity for us here at SGK from a portfolio management standpoint.
Absolutely. This is something you've actually heard us talk about before as one of the telltale signs going forward and actually sources of risk. So what does it mean actually to the economy at large? Effectively, the 10-year Treasury is what a lot of the loans actually are based upon. The 10-year, the 30-year conforming mortgage is based on the 10-year Treasury. The 15-year mortgage based on the 10-year Treasury. Your student loans are based on the 10-year Treasury. Even car loans are based on the 10-year Treasury. So as you see that yield actually go higher and higher, it does act as a bit of a headwind for consumers and even businesses. So specifically, what does that mean for your portfolio? So because of that inverse relationship between price of bonds and the yields, as the yield goes higher, the price of the bonds go down. So it can actually cause the bond portion of the portfolio look like the performance is actually dropping some, but it's something that, again, if you're investing here with SGK, is something we're not quite as concerned about. Why? Because we buy all of our bonds at a discount. So as we're buying them at a discount, what do you ultimately get though when they mature? You're getting 100 cents in the dollar. So that's why you're not quite as concerned about that. What it also means though is also an opportunity, because many of the corporates we're looking at these days, we're able to get those in the high 4s to low 5 arena, which again is really attractive right now.
Sure, yeah. Even the Treasury market, we were setting up a client portfolio today, and there's no more liquid market than U.S. Treasuries. It's the only security. If you sell it right now, the cash is immediately available. It's not even one-day settlement. We're seeing yields north of 4%.
Yeah.
Taxable accounts, you don't pay state tax on the interest. You get a lot of liquidity. And again, we might pay 98, 99 cents on the dollar. And we know we've locked down that yield the day we buy it, whether it's a corporate or a Treasury, and it will mature, as you mentioned, at 100 cents on the dollar. Now, why is that important? You think back to 2022, it was a tough year for the stock market, down 18, 19%. The aggregate bond ETF was down over 13%. So if you're a non-SGK client, you're using an advisor that's putting bond ETFs or mutual funds in your portfolio.
Yeah, nowhere to hide.
Come talk to us, right? Because our clients did not experience that level of pain in their fixed income portfolio. But on that note, so the reason why yields were up, it's tied to oil with the conflict escalating again in the Mideast, and we do hope for a resolution there. We saw Brent crude, which is the international price of oil, get back above $100 a barrel. Here in the U.S., gasoline rose again above $4 a gallon, and that's, again, another headwind for the U.S. economy. The flip side of that, though, is the odds of a rate hike have increased. Here in July, the FOMC meets at the end of July, are now at 40%. So it's increasingly on the table. I heard Kramer the other day talking about that's not necessarily the worst thing if the Fed increases short-term rates, because it may put a lid on the 10-year and the 30-year Treasury yields rising any further.
Which is counterintuitive, but
it is counterintuitive. But when the Fed cuts rates, it's expansionary, it's inflationary. When they increase rates, it's the opposite. It's deflationary. It's designed to slow the economy, and that should contain those longer-term yields.
Exactly.
Real quick, though, on the 30-year, there was some interesting stats on the 30-year yield.
So to go ahead and put things in further perspective for you also. So again, the 30-year Treasury yield has actually stayed above 5% for the longest we've seen since 2007. This is ultimately due to the fact that, again, the overall deficit situation. So the investors are actually demanding higher rates for, again, holding that debt for longer periods of time. This is something that, again, we haven't really talked about a whole lot, but it's not a situation which has gone away. The Treasury market has actually grown to $31 trillion from $4.5 trillion in 2007. That's a lot. Okay. And so what does that mean as far as the interest? The actual service on that debt is $1 trillion. That's actually higher than our defense spending. That started back in 2020.
We have to get our fiscal house in order here in the U.S. The only saving grace is the fact that other countries are in worse shape, basically. Yeah, exactly. But we had some news on the job front. It was pretty solid, right, Eric?
That we did, as a matter of fact. So first time unemployment actually fell to 187,000. That's the lowest we've seen, you ready for this, since 1969.
So that was weekly claims.
Exactly, right? And that was actually a drop of 22,000. This is far below economists' expectation. Again, continued claims actually were steady at 1.8 million. So again, what does all this mean? This is something we've said before, even though you're hearing lots of headlines about lots of job cuts, ultimately, in aggregate, the job situation is still remaining relatively steady state. I know we had some also international news.
Yeah, our neighbor to the north, Canada, they had May inflation report come out. It dropped to 2.8% from the prior month, 3.2%. Why is that important? Well, it was due to declining gasoline prices mainly. Now, we may see that in Canada, but also here in the U.S. reverse course in future inflation reports. But what's interesting, too, is the loonie drop relative to the U.S. dollar. So if the Fed here is on the path of rate hikes, one of the advantages if you're traveling internationally is the strength of the U.S. dollar.
Yeah.
If we're inclined to increase interest rates, then from a currency standpoint, it results in a strengthening of the U.S. dollar relative to other currencies. So it makes it less expensive for us to travel internationally.
Right.
We had a bunch of companies report earnings this week. Eric, Alphabet had a great report. I know you love to talk about Alphabet. Why don't you start with that one?
That's one of my favorites, actually. I kind of consider them somewhat the Swiss Army knife. You get 5 different companies all in one wrapper. So Alphabet actually beat Wall Street expectations. Revenue jumped 24%. That's $119 billion. Among the businesses there, cloud computing revenue jumped 82%. That's $24.7 billion. It's off of strong AI demand. YouTube, which again, a lot of people forget that YouTube is actually one of their main sources of revenue. Revenue there jumped $11.05 billion, also topped estimates. Separately, Google is also developing a new server chip. This is the Frozen V2. This is something you're going to actually see a lot more in the future. Instead of generalized chips, you're actually going to see more ASICs, which are specific to any particular function. So again, really fantastic news. But I know we had some other companies.
Yeah, and Alphabet, the stock dipped after earnings, but I see it bounce back a bit today. So that is a good news story there, definitely. Yeah, we had Kinder Morgan Inc. So they are a pipeline company, the biggest in the U.S. So they push natural gas through pipelines, other energy as well, including oil. Really super solid report. They beat expectations, adjusted earnings at 37 cents a share on revenue of $4.48 billion. Net income rose 21% year over year to $867 million. That was a record second quarter for them. They attributed that to rising demand for LNG, liquefied natural gas exports, and also just industry demand, in particular data center. They always cite data center growth, and obviously you have to cool the data centers, you have to have generators, etc. NextEra Energy was another one. It just came out this morning, actually. The largest utility and clean energy company in the United States. They own Florida Power and Light, for example. Again, they cited data center demand for energy as a key driver of not only growth in the prior quarter, but future growth as well. So their net income climbed 55% to $3.14 billion. Revenue rose 12% to $7.5 billion. And not only did they back their full year guidance, but their future projected guidance in future years. So they're expecting a dividend increase of 10% this year and a minimum of 6% over the subsequent 2 years. That's how confident they are. They're also doing the big acquisition of Dominion Energy, which we like. They filed with regulators, not a done deal yet, but it's definitely something that looks like it should go through.
I'll take it.
Yep, absolutely.
So that about wraps it up for us this week. Thank you again for spending your time with us. We hope you have a wonderful weekend. And as we say here at SGK, cheers.